All right, so in this video, I'm going to talk about my near-term view for gold and silver and my overall large macro view, spurred by this conversation I had with someone in the comments under yesterday's video, where we kind of had a back and forth debate. Me and this person we had two different views. This person thinks that we are in a bear market, whereas I personally don't think we are in a bear market yet. I still think that there's a case here for stronger action in gold and silver. And that's basically based on my thesis that we are still approaching a short run, or we could even be in one right now, a short run stagflationary environment. Now, before I get into that, please hit that subscribe button right down below and please join the channel. Definitely want to make sure that when you wake up and you see big red candlesticks, you aren't taken aback and you don't know what's going on. I'll help you with understanding where things are kind of happening. Now, also please hit the like button so this video can get out to more and more people. So here is my general view on things. I do think we are approaching or are currently in a stagflationary environment, and more news that's coming out, and even just some data, is starting to veer towards that. Now, today we are seeing some weakness in prices. We had already been noting before some developments happening in Europe, we already had been noting that we kind of hit a peak here in this near-term rally, and we should be expecting some weaker movement. We did note that, but the severity of it has been wrought by what we've been seeing across the water. Now, we'll touch on that a little bit because there are some interesting developments there as well. Now, currently, where we stand, silver's at 23.54, gold is at 17.91. And we did cross below this trend line here for silver. And the interesting thing about silver is that we never really had a real golden cross develop. The only precious metal between gold and silver that had one was gold. I mean, take a look here. This is the near term 20-day moving average, and here's the 253. We touched it actually in price action, but we never actually crossed it with a moving average. So as opposed to gold actually did cross above several days ago. Now, if we take a look at this trend line here for gold, on the other hand, the trend line actually shows that we haven't actually broken below. So again, gold is actually holding a little bit of its own right now in this environment. And we are pretty much, essentially approaching oversold territory. Currently, we're at the 42 right now, the RSI. Oversold would be around 30. So we're getting pretty close to it while we're still in positive territory in the MACD. So again, though we are seeing weakness, I don't really see a huge case for prolonged weakness here. Now, there are going to be hiccups with the strength in gold and silver prices. Now, what exactly am I talking about here? Well, before I get into those hiccups, I do want to point to more of an aha moment that I had when it came to inflation. Whereas we woke up this morning and saw that Biden basically said, hey, we're going to release some oil from reserves so that we can keep oil prices down because they're getting way too high. Gas prices are getting way too high. And here's the thing. A president wouldn't do that unless they think that prices will remain high. Again, this is essentially them kind of showing their hand and saying that even though they may believe that inflation is transitory, they aren't just going to sit by and let prices rally to the degree that they have been, and they're going to try to do something to bring them down. And obviously, oil is essentially one of the commodities at the very top of most value chains in most industries. You're going to need oil to do most things, even oil to protect yourself in war. You need oil. So having those prices drop is going to be paramount. And because he thinks that they're going to remain high, he's saying, hey, let's drop these oil prices. And because of that, we saw oil drop 1.9% today to a low of $75.30. Remember, we were in the 80s, several days ago. So we're starting to see things like this develop because there's an anticipation of inflation. But when it comes to stagflation, that means we're expecting low growth. Well, take a look at this. And I'm on Market Watch, so it's going to be kind of laggy here. But take a look at this. This is the yield curve. The light blue line is where we were last year around this time. And want to actually show it to you again because, again, Market Watch is very laggy. But that light blue line was pretty much where we were a year ago at this exact time. And the black line was pretty much where we are currently. And I'm just waiting for it to populate here. Now, once it shows up again, you'll see that last year, it looked like we were kind of steepening a little bit. But with the current look of the yield curve now, it looks like we're actually beginning to flatten towards the longer maturity dates on the yield curve. And while that loads, I want to show you a chart that basically shows this as well. Now, all right, so the graph is actually behaving. So here we are. What this actually means is that there is an expectation that economic growth will actually be is expected to be more muted in the future than our expectations were last year. Our expectations last year were that, hey, things might be looking pretty good for growth. For us, our expectations now are things might be looking a little bit muted. So again, this is a little bit of a look into the future. Again, when we look into the bond market, that's one of the reasons why. That's one of the reasons that we look at the bond market, to get a gauge and read on the future. Now, again, we're talking about the flattening of the yield curve. And this article is written on November 1st. And they noted, this author, David Randall, noted that, hey, why is the yield curve flattening and what does it mean? And basically this article is, rehashes pretty much what I said, which is, hey, there's expectations of slower growth with this, with shorter term treasuries rising and the longer term ones reverting. Now, one of the cases for this is that because of the expectation of rising inflation, there is actually an expectation of rates rising aggressively. And funny enough, some surveys went out and there's expectation that in Britain, we may actually see a rise in rates in December, quicker than expected. And that's pretty much what a lot of people are looking at right now. Are rates going to rise quicker than expected? And that is why some of that flattening is developing, because, hey, we may start to see inflation get a little bit crazy, and we're trying to front run that. But with that means higher borrowing costs, and with that means lower growth. But at the same time, inflation is going to be one of the causes here. So it's not going to be perfect, and we may see some Venn diagram-esque inflation on one side and stagnation on the other side come together and form stagflation. Now, when it comes to the near term, and we see prices of gold and silver lag a little bit here, one of the reasons for that is because of what we've been seeing recently within Europe. Now, I've been talking about this the past couple of days, but here's a map of Germany or Germany's cases. Turns out Germany has one of the largest cases in Europe. Now, for those of you who think that this isn't going to be an issue, you have to realize that the world economy, the three largest economies basically are the US, China, and the Eurozone. And one of the largest countries for GDP is Germany. And, obviously you're seeing things like this. US issues do not travel warning for Germany and Denmark. So pretty much all in that area, as you saw on the map, we're seeing these rising cases. And because of that, that's probably one of the reasons why we're seeing the dollar rise and the euro fall relative to the dollar. Again, here's a better look at that with you have $1 US to 0.89 euros. And over the course of the last several weeks, we were at 0.86 and we've risen to 0.89. Now, some of you yesterday in the comments were saying, well, hey, that doesn't really mean that much. We only rose, like from 0.86 to 0.89. That's not much. But you have to realize that foreign exchange markets are quoted in pips. So you're actually quoted. It's actually quoted to the thousandth place. I think I said that correctly. But basically 4 decimal points. You're not seeing that here on the screen. So if you go from 0.86 to 0.89, you have to take into account that those 4 other decimal places. So that's a huge run up. Like if you had money betting against the dollar in favor of the euro during this time, you probably I don't even want to think about it. But essentially, things are looking pretty rough over there in the Eurozone or the Euro area. I'm not sure what, I think it's the Eurozone or Euro area, one of those two. And in Germany particularly, it's looking pretty rough. You have people like, Chancellor Angela Merkel saying, measures need to be taken to stop the spread in Europe, Europe's biggest economy. So essentially what I'm saying here is that we are having hiccups right now that are preventing gold and silver from continuing their run. But in this environment, a stagflationary environment, inflation is not going anywhere and growth is lower. We should expect to see gold and silver prices hold their own. So again, in my view, I don't think that we are in a bear market. And I think that gold and silver lean more towards higher prices. But that's just my view. Let me know what you guys think in the comment section below. Please hit that subscribe button down below. Please hit the like button as well.